How we doing, Ryan? As you take a drink.
Yeah, wonderful, James. Thank you. Thank you very much. Perfect timing. Yeah. Looking out for one another.
That's right. Hey, looking back at November.
Oh my gosh.
What we got a couple of housekeeping things. But.
Yeah. What an exciting month, though, across asset classes. So, but before we dive into that, as we entree into the holiday season, it's been a tradition of ours that we send Christmas cards to clients, and part of me feels that some of these cards never either make it to the mantle or, they're overlooked with all the junk mail that we get these days. So we're always looking to have a better way. Yeah. We're always looking to innovate. And so one of the things that we're going to be doing is phasing out the physical Christmas cards, and the money that we're saving for that, we're going to start getting very active with charities, and we're going to rotate the charities. So more to come on that, but don't be alarmed if you're noticing a difference there. For those of you who really just want that physical Christmas card, or if it's your only one, let us know. We'll get it out there to you. But for those of you who think that's a cool idea, we appreciate you backing us there. It's just our way of really trying to find a way to make a difference. So again, happy holidays, everyone.
Yeah. Looking forward to them.
Yeah, absolutely. So the excitement of November.
Yeah, I think statements felt different. I know I had a couple people, giving a call and an email, and it's like, we're trying to be in position to take advantage of those kind of months when they happen.
Well, look at 3 months of just slog lower.
Yeah.
Can set you up for a big reflex higher. And so it's great. And there's a lot of reasons, and I think we can study why the markets did so well in the month of November. But S&P 500, top 500 companies in the U.S., up just shy of 9% for the year. So, for the month, excuse me. So, in the month of November, 8.67% to the upside. Bonds were not spared in this. They were not left behind. How about that?
Because they have been.
They have been. But again, remember, bonds move, generally speaking, opposite of interest rates. So rates kind of collapsed on us in November for a number of reasons. And the aggregate bond index, which is just the basket of bonds, a diversified basket of bonds, was up 4.41% for the month of November. So that was tremendous.
Right. And we always like to look back at the different months of these podcasts, right? But I guess as we get closer to the holidays, we get closer to next year, how do we think 2024 is going to look? Or what do we think some of the themes might be?
Okay. So are we doing this right now? Are we going to give our forecast, our model?
We could.
Okay. Well, how about this? Let's leak into it a little bit, and then we'll make the call for the December pod.
Yeah, that's what I was
setting up for 2024. But looking at 2024, It's interesting because everybody's been waiting for this recession, right? Okay, everybody that hasn't manifested.
Right.
Normally, that's how it works. By the way, the recession or the market move that everybody sees coming is typically not what happens.
Yeah.
So when you look at 2024, I think a lot of it is going to be driven by the plumbers. And you might say, well, what are you talking about, plumbers? Well, recognize the capital market infrastructure is like plumbing, right? And what flows through it is money. So are the plumbers going to allow freely flowing capital? And maybe it's from some things that are not necessarily organic. For instance, government spending. I mean, a lot of November was driven by just a few changes in governmental policy that collapsed interest rates, maybe to how we're a difference in calculation of CPI, or maybe how we're funding our government. So a lot of this is going to matter, I think, on our policymakers, our governments, willing to flip the levers and move the levers that will allow that flow from just government coffers into the economy, or are they going to allow the actual organic economy to kind of run its course? And so it's big, because if they just continue to kind of push capital out into the markets and liquidity out there, you're going to see the economy expand, the markets expand. But if it's kind of but the problem with that is it's not natural. Right. It's not what you would historically think of. So, I mean, it would be the end of the credit cycle in a way. I don't know. Would they want to entree down that road? Maybe because it's an election year or something like that. That's going to be the key. Right. So I'm doing a lot of digging. I know that you're right there with me.
Yeah.
We will have some guidance and I think some narrative to
Some
it.
interesting thoughts.
To
You know, kind of
2024.
looking ahead, we got a lot of those balls in the air. And
But isn't it amazing how you look at, again, two things that really stood out in the month of November? Basically, and this is looking in the rearview mirror. So CPI, we get CPI, Consumer Price Index, for the prior month, right? So we got the October CPI index, and they changed how they weighted like healthcare costs. And all of a sudden, it really is meaningful, and you get this lighter CPI. But did it really change what's happening out there? I don't know, but you had a lot of computer traded algorithms that fired off. We'll take it, you know.
We'll benefit.
Also, another thing that took place in the month of November that I found interesting and unique, Janet Yellen, our Treasury Secretary, prioritized the issuance of Treasury bonds. So, you know, every month at weekly Treasury bond auctions to fund our government. Well, if you don't like what's happening in one area of the Treasury auction, typically you don't, but I guess you could, which we did, change and meet the demand kind of where it's at. Now, that's not typical, but yet again, that put a cap on like the 10-year Treasury bond yield. And it was amazing to see the market respond so positively to that. So, you know, again, these are going to be things that we need to be watching, but they're very meaningful.
no, and we'll stay on it. Like you
Yeah.
said.
Without a doubt.
And we enjoy it.
Yeah. Oh, yeah.
So before we kind of get too far into 2024, you know, I guess, you know, you and I talk about Metallica and some of the different things that are out there, but, you know, we're kind of thinking, you know, who's in good shape for maybe decisions they made even a couple years ago.
Yeah, so it's kind of for whom the bell tolls. I think
Exactly.
you're getting at. It's kind of this idea. A lot of in our area, a lot of billboards have sprung up with those selling insurance products,
Right.
and annuities. They make you feel good in challenging market times.
Probably had record years in
Record
2022
years.
selling
Yeah.
on fear.
Right. That's the thing, though. These annuity products, they seem like a silver bullet. It handles everything, but it's being sold. It's a product typically sold by insurance people. So, you know, they typically have their time when markets are extremely volatile, when investors are extremely discouraged and scared. But those annuities have populated out into society, and it's one of those things where I think that their time is running out.
Right.
I think that when you look at times of market and economic stress, it doesn't last forever.
Right.
And the majority of the time, we have good things happening in our economy. Less frequently do we have really challenging times. So again, we feel that probably a lot of individuals out there in the world have been sold and preyed upon from a fear perspective.
Right. Just
You
up
know,
here.
again, and so if anybody's out there and wonders what they've got,
Yeah.
what they got themselves into, by all means, reach out. But this is the point at which those billboards probably start disappearing.
Right.
You know, as we get into 2024, because perhaps that credit cycle will kind of put us on the doorstep of something we can be positive for the long term.
And they're not designed to take advantage of what we've had, you know, the
Yeah.
last 12 months. You know,
talk about it.
Well, you think about it, it's been up. The markets, the S&P is up probably somewhere 20-30% since October of 22.
So you want the Well, I'll tell you, 20%, 21% to the upside for this year.
For this year.
Yeah,
So-
but off the lows, right? Yeah.
And the way that they kind of protect themselves, the annuity companies, is sometimes you don't get all of that gain. So if you got in at those lower points when you were the most scared, well, now what do you do? And I guess we'd want to help you make those decisions if you or someone you know did decide to put some of their life savings into one of those products.
Right.
You know, we can take a look, give you options, maybe an exit strategy, or what would be in your best interest with what he or she has done during that time frame.
Right. Yeah. The general rule with these things is the minute you start seeing guarantees and things like that, recognize you're paying for them.
Yeah.
And they're really, you think that it's an investment, but quite frankly, it's an insurance product, right?
Yeah.
And so it's not a lot to unpack there. But anyway, if you're starting to get worried, or your neighbor,
Yeah,
By all
that's right. Exactly right. So another thing that you and I have heard a lot from our clients, you know, and we've even talked about it in a different podcast about, you know, if you have idle cash, or, you know, maybe the risk-free rate has changed a lot in the last couple of years.
Yeah.
But let's get just a little into that, Ryan. You know, how do we look at that? How should we look at it if we decoded it?
Yeah.
You know, what does it mean?
So for the general public, if you will, let's talk about that. It's wonderful because that's what you're going to get in an interest rate in a money market account, let's say. That risk-free rate. Think about it. A money market position is a cash-like position.
Right.
But you're not taking the risk of owning debt, which would be a bond, or owning equity, which would be a stock. And you're going to get paid. And let's call that 5%.
Yeah.
Okay? That's your risk-free rate. Now, if you're talking to me, I'm going to get down into the weeds a little bit more, and I'm going to say that's our risk-free rate for doing nothing. Then I'm going to take it a step further and say, well, what is the premium that I would get, that I would anticipate
Right.
with owning stocks? And then I'm going to start to stocks or any other type of risk asset. I want to know what the premium is going to be for that. And that's where I'm going to start to take fundamental factors and things. But it's so important because that risk-free rate drives a lot of probability decision-making processes. And why that is because if I can make 5% not taking risk, well, does it make sense to then all of a sudden add risk for what benefit?
Yeah.
Right? And then all of a sudden you're making that, you're using probabilities to decide, does it make sense to take that extra risk? So listen to the risk-free rate. And if you ever want to talk about that, by all means, reach out. But quite frankly, when you're getting paid 5, boy, it sure takes a special environment
Right.
to get me out on that risk range. So just think of that, conceive that, recognize when the risk-free rate is up where it is right now, it's telling you something, and you should listen.
Yeah. And we always talk about, one of our jobs is to make sure that we as, advisors and money managers are having our clients get paid properly for the risk that we're taking. So kind of like pulling the curtain back,
Right.
that's kind of what you're getting at. You
Yeah.
know, if I'm getting 5 risk-free, should I? Or if I did, am I going to get paid properly for it?
We exist to manage that risk-adjusted return relationship. Risk-adjusted return.
Yeah.
All right?
So if we've had a higher risk-free rate than we've been used to the last few years,
Yeah.
and now we're kind of getting towards the end of 2023, which we're not there yet because we're just kind of getting through November, how should we interpret what has gone on in 2023?
Yeah.
The
Well,
results, investments.
Yeah, I think that what you're seeing is a dramatic bifurcation in asset classes returns. I mean, quite frankly, if you own the Magnificent Seven, so large, cap growth companies, you're feeling really good, but it's not diversified.
Right.
For those of you who are just starting to kind of break even on the, the small and mid cap portion of the portfolio, it's been a tougher, bumpier road. Bonds are kind of benign this year as well. So it's just 2023 has been a big divergence with respect to asset class returns. But be patient, because what this means is that the capital markets are sorting it all out. There's an element of confusion within the capital market system. And I kind of touched on it for this 2024 outlook at the front of the podcast. It's like, well, wait a minute. If you have government authorities who will just literally flip a lever,
Yeah.
and all of a sudden then capital can flow in, well, that's kind of different than if we're relying on the organic growth. So where are we going? And this is true of digestion periods. You're going to see a lot of different returns across different asset class spectrum. But the beauty of it is, once we can get a trend sorted out,
Yeah.
it's pretty simple from there.
Yep. Start to tilt and figure it out.
Yeah,
for
but
you.
2023 has been a very bifurcated year.
Yeah. And we were going to talk about it kind of in the next pod, but we wanted to kind of fast forward it to this one with the last couple years in clients' income and withdrawal rates.
Yes.
Right. How much people are taking out of their portfolios each year, and what's gone on in the market the last couple years might be something we want to reevaluate, touch on, look at, budgets, all of it.
Right. Well, and that's a big part of why we exist in individuals' lives, families' lives, because we can help determine what's reasonable from a wealth perspective, a spending perspective, a trajectory perspective, and then give our thoughts. The issue that you run into is when you hit a soft patch in the capital markets, it's going to exploit maybe some bad behavior that could have been covered up by blockbuster returns. From 2018 till 2021, I mean, it was tremendous.
Yeah.
Tremendous place in the market. So it can mask those challenging, income streams that would put pressure on a portfolio. But it's like, we're booming.
So what does it matter?
What does it matter?
I'm okay.
But now I think those who are seeing maybe balances erode, we're positive this year. So if you're seeing your balance erode, recognize that you could be taking too much money. And if you're nervous, that's probably the easiest solution. It is.
Yeah.
It's the easiest and most effective solution to protecting the balance within your portfolio. So this is a time where you want to just reevaluate what your goals are. Maybe you want to spend down your wealth as you move through your life. Okay, well, maybe you're willing to take a little higher withdrawal rate. But recognize you need to expect you're going to see less and less on a statement. For those of you who still want to build and want to focus on that rock solid longevity, pick your head up, look around. Yeah. What's the range?
Yeah, in that 4 to 6% a year is kind of what we would say we're most comfortable at, depending, and that's just like the 30,000 foot view.
Blanket exactly. Statement. So I think too, it's like, are you adjusting for inflation? What's your goal at the end of the road? Like, what are you trying to leave a legacy of a certain amount? Those are the things that we work with our clients on to try to determine whether a retirement plan is viable and continue to evaluate. So definitely reach out if you'd like us to take a look at things for you.
Kind of not necessarily along those same lines, because that's kind of maybe protecting the portfolio from yourself, right? If you're pulling too much money from the portfolio, and we're trying to manage risks, so we're trying to, we'll say, quote unquote, protect it from the markets. You and I have been talking this month. One thing I don't think we've talked about in this podcast since it started, we talk to clients, often about it, but how is the portfolio being safeguarded from criminals?
Yeah.
From people outside of you and I, the client, and the firm and the custodian. Outside of that, how is it being safeguarded?
Well, and this made it on our list in talking with colleagues and recognizing, my goodness, there's a lot of bad actors out there. And they're targeting all of you. And so they're targeting you in a number of different ways.
Right.
And I've seen so many different variations of a risk out there. But this is a point in time where we want to highlight one of the reasons that we're important in your life. We know you well enough to know that you don't typically ask for a withdrawal that way. So we're going to call you. James, you had mentioned, well, why don't you go ahead and how individual closed an email?
Right, yeah. We were talking, I had a situation where I had a client, whenever she would email me, it was, I'll call it like a whimsical. She was a very caring person, very warm person, and it would always be sincerely or warmest regards or hope your family is doing well. All these little things that I guess I took after knowing her for so long that it kind of meant something to me, right? Well, I got an email about helping their nephew with a wire, and it just ended with her name. And I was thinking, not only would you normally call about that to make sure that you can't just take a wiring instruction on email, but the way that she ended the email, I was thinking something's got to be going on. So I called her. She said, no, I never requested a wire, but maybe Mark got into my email and said, oh, I'll do it that way. Yeah. Called him. He was on the golf course. He's like, absolutely not. I never asked for a wire. So then we go ahead and go through the financial back channels to kind of back up that. But that's phishing. We do lots of things. Our technology department tries to protect the firm. We definitely try to protect our clients on that.
We have what I would consider military grade IT protection. And they work with us a lot in training and what have you. So again, we stand ready for duty, and our goal is to protect on many fronts.
So much so, sometimes I joke with one of our IT guys, I'm just going to start sending you all my emails and tell me what we can touch and what we can't.
It's like an effective strategy.
I know. Well, as we look ahead, Ryan, end of the year, the holidays, next year, maybe more specifically December.
Yeah.
What do we think what are we looking at?
Well, I could tell you, seasonally speaking, December would be a time that the market can tack on to some of this November momentum. But November was such an outsized move that it probably needs to be digested a little bit.
Yeah.
After all, markets are trading at pretty high multiples relative. And just think of this from this perspective. If I'm paying for a business, the price that I'm willing to pay should be in line with how profitable that business is. If I'm going to make an offer on a wildly successful business, well, my offer better be up there.
Right.
But if I'm going to make an offer on a business that's just breaking even, well, I'm paying for the real estate essentially. So you got to keep an eye on price to earnings multiples. Even though that's rational thoughts, the market doesn't always have to be rational. But recognize that we might need a little bit of digestion. We certainly want to know where inflation is. We haven't really talked much about interest rates this time.
Not today.
Make no mistake, they're still very important.
We're giving everybody a break.
Yeah, it's a little break. And guess who holds the keys there is Jay Powell. So we'll get a meeting in December, probably no action from their part, but we'll listen to their messaging and what have you. So, let's just slide into the end of the year on maybe that Santa Claus mindset and hope that the market continues its momentum in the right direction. And we'll jump into the 2024 outlook soon enough.
Sounds good. Happy holidays, and thanks for joining us.
Yeah, absolutely.